Best thing to do if you want to invest for the long term
is index.
And it's the S&P 500 index.
Right.
Which is right for you, a low-cost index fund mutual fund or a low-cost index fund ETF? Today we're going to look at the differences, the pros and cons of each, and find out which one would be best for you. If you like content like this, press the like button so that YouTube knows to recommend this video to others. And feel free to subscribe also. What is an index fund? An index fund is an entity that tracks a collection of stocks that's in an index, such as the Standard & Poor's, S&P, or also known as the S&P 500, or the NASDAQ 100 is another, or the Dow Jones is another. And it's basically just a collection of stocks, like in a basket. You know, you could have 100 stocks or 500 stocks, like with the S&P 500. The index is just something that tracks it, that you can trade. Rather than having to buy 500 stocks individually and head buy, and you'd spend all day and you'd spend a fortune. For very little money, you can buy an index mutual fund or index ETF and own all of the stocks with just one transaction, or you can sell it very easily. Types of entities that hold stocks as a group, you've got basically three types. You've got a mutual fund, an exchange traded fund or ETF, and then less often you have a closed-ended fund, and they trade ETFs and closed-ended fund trade like stocks, whereas a mutual fund trades a little bit differently, a lot less often. The first mutual fund was started in 1924 by Massachusetts Investor Trust. Here you can actually see their website. They're still in business today. I guess they're going by the name MFS. Do you know what this says? Class inception 07-15-24. Do you know what the 24 stands for? 1924. So that's pretty amazing that they're still in business. Now they do have a higher expense ratio, 0.70, which is way higher than what Vanguard has. The first mainstream index fund was started by Jack Bogle. This was one of the first popular ones that Jack Bogle popularized. Jack Bogle of Vanguard in 1976. So he started this fund in 1976. Now it wasn't called the S&P 500 fund then, it had a different name. The first one we're going to look at is Schwab S&P 500 Index Fund Mutual Fund. It has a 0.02% expense ratio. The second one we're going to look at is the iShares Core S&P 500 ETF. It has a 0.03% expense ratio. The next one we're going to look at is called the Fidelity 500 Index Fund. It has a 0.015% expense ratio. The next one we're going to look at is sort of a new one from Fidelity called Fidelity Zero Large Cap. Now it has zero. This one has zero. If you look at the expense ratio here, you can see zero. The next one we're going to look at, this is probably one of the largest and longest running. This is sort of the one that set the standard for ETFs. This is the Vanguard S&P 500 Fund ETF. VOO is the ticker symbol. It has a 0.03% expense ratio. The next one is the Vanguard equivalent of the Vanguard 500 mutual fund version. It's called the Admiral Shares. This is the ticker symbol for the mutual fund. It has a 0.04% expense ratio, and it has a very high $3,000 minimum. Those other ones that I showed, Fidelity has a $0. There's no minimum for Fidelity mutual funds, and for Schwab mutual funds, it's only $1 minimum. Really low minimum, so you can't really say that ETFs are easier to get into anymore. This industry changes so much. While we're talking about fees, I just want to mention something that I think is important, and I think this is kind of misunderstood. I've seen a lot of YouTubers, they seem to misunderstand this. So both mutual funds and ETFs, exchange traded funds, the expense ratio is not deducted from your account. You will never see this fee in your brokerage statement in Vanguard and Fidelity. You'll never see this fee deducted from like a ledger or activity statement. It's not like the old days where they deducted the $10 trading commission from your cash balance in your brokerage account or mutual fund. You will never see this anywhere. This is a hidden fee. This gets deducted. This is the annual fee, but I'm not sure how often they deduct it, but it's taken out of the net asset value. So for example, if this were a dollar fee every single day, the net asset value would go from $353 to $352. That doesn't mean that this doesn't matter. It just means that you won't see it. So if you've got a high fee, it's probably going to impact your returns. That the ETF or mutual fund doesn't do as well because it's loaded with expense. When you see a stock chart like this ETF, this is the Vanguard S&P 500 fund ETF. This is the current stock price. When you see this here, all of this, you don't have to deduct any fees. So this 346 that it's currently trading at, 346.26, that's the current selling price. The fees, you don't have to deduct. You don't have to deduct the fees anywhere. All that work has been done for you. Higher taxes. Mutual funds have higher taxes typically. Now this is less so with Vanguard, and I'm going to show you here. That's why everyone has been recommending Vanguard for the longest time. Now, this is from a Bloomberg article. I'm going to put a link in the description in case you want to look at it. It's quite interesting. Now you have the Vanguard mutual funds below. This is the Vanguard Total Stock Market Fund. These little black squares that you see, these are taxable gains. And you can see all, it started around 2001. You can actually look down below. This is around 2000, 2001. Now, 2001 is when the ETF started to become popular. After they added the ETF, look at this. You don't see any black spots on the Vanguard Total Stock Market Fund. No tax distributions. So you're not going to get a distribution at the end of the year that you have to pay taxes when you haven't even sold it. Now you look at the Wilshire 5000 index. They have, even in the most recent years, 2016 through present, you see that they have taxes. Here you have Fidelity Total Market Index Fund. You see that they still have tax. They have quite a few years with taxes. So Vanguard definitely looks superior. It has to do with the patent and it has to do with ETFs. That's why the taxes are lower with Vanguard. They have a patent on the process. You can see the same applies to small cap. So all of their indexes, I think pretty much all of their indexes, they have corresponding ETFs that they mix together the assets, and they do it in such a way that they reduce the tax burden. Now you can compare it. It goes iShares also taxes. Schwab small cap, lots of taxes. Vanguard mid cap, no taxes. Okay, let's compare the capital gains taxes for the various mutual funds that we looked at earlier. So the first one we have is the Schwab S&P 500 index fund, the one with the 0.02% expense ratio. And you can see here, these are the distributions that the dividend income, capital gains. Now you don't have any capital gains with ETFs. That's why they're superior with the tax efficiency. But here you can see that in 2015, they've got long-term capital gains. This is taxes that you have to report, and you would actually have to pay if you're over the threshold. I think it's $40,000 income. Let's see, short-term capital gain. Now they're not really big, but you can see here long-term capital gain. Now this is actually probably, most of these are probably less than 1%, so you're not talking about a huge tax bill. And the short-term ones are the worst ones. That's the ones that are taxed at regular income rates. But they're still, you're talking about 1 cent per, net asset value share, I think. The next one is the Fidelity 500 fund. The dividend, okay, you can't get around the dividends. Even the ETFs have dividends. But the capital gains here, you can see 2019, 11 cents a share. It doesn't look like they break it down to short-term or long-term. This one here in 2018, they had 37 cents a share. Fidelity Zero is a new one, so you're not going to have a huge history. You can see right here, it's free, but it's not free completely. I mean, you still may have to pay taxes on the capital gains. But we're talking about, 1 cent a share. That's not a whole lot of money. It looks like the net asset value was $8.50, so that's less than 1%. The next one is the Vanguard 500 Index Mutual Fund, and you're going to see why they're superior. So if we go down now, you click on distributions. You can find this for any mutual fund. Now, they have dividend, income, and capital gains. You'll only see dividends. You won't see any capital gains. It's just like that chart showed. There's no capital gains because they have a patent on the process and it removes all of them. There's less pricing transparency and liquidity with the mutual fund. the net asset value is calculated at the end of the trading day at 4 p.m. You can see here that this is the chart for Vanguard 500 Index Fund Admiral shares. You see all these straight lines. These straight lines indicate that they're not trading throughout the day. If this were like a lot more jagged lines, like the ETF, you would see that they're traded throughout the day. With a mutual fund, you are buying and selling from the fund itself and not the investors. So with an ETF, you're buying from other investors. You're not buying from Vanguard itself. And so you can use different brokers. You don't have to go directly through the company. Now, mutual funds, you don't have to go through the company, but the underlying process of the buying and selling is done by, let's say, Vanguard or Fidelity. Mutual funds have no bid-ask spread. You won't see, it says NA, NA, NA. Now, if we actually look at VOO, so basically every stock that's traded, all of the underlying stocks that they buy for the mutual funds have a bid-ask spread. Here you can see the bid-ask spread. You can see right here. This is Vanguard S&P 500 Index Fund. This is like, the difference between buyers and sellers. You've got 347.13, 347.18. That's the spread, the difference. It's a pretty tight, if it's a very thinly traded or less popular like the SOFI 500 fund, then this is going to be a wider range, which means you have the potential to lose more money on your trades when you buy and sell. Index mutual funds may have withdrawal restrictions. The first one I'm going to look at is the Fidelity 500 fund. The fund may reject for any reason or cancel transactions deemed to represent excessive trading at any time. How to get banned by Fidelity. If you have 4 or more round-trip transactions within any 12-month period, you will be blocked for at least 85 days from additional purchases across all Fidelity funds. So what's a round-trip transaction is buying and selling within 30 days. So like buying in May 1st, selling May 30th. Any round trip within 12 months of expiration of a multi-fund block will initiate. Oh, okay. So it says any round trip within 12 months of expiration of a multi-fund block will initiate another multi-fund block. Repeat offenders will be subject to long-term or permanent blocks of purchase or exchange of transactions. They also may reject or cancel your orders. Now, there's some exceptions to this. If you have a automatic investment program or automatic withdrawal, and then also I found another document that says if the transaction is $1,000 or less, you won't be subject to that policy. Shareholders with 2 or more round-trip transactions in a single fund within a 90-day period will be blocked from making purchases for 85 days. Here's the Fidelity 500 fund website, and they also have something I found at the very bottom of the screen. The fund may charge a short-term trading or redemption fee to protect the interests of long-term shareholders of the fund. I looked for this fee in the prospectus and I couldn't find it anywhere, but it does look like they can charge you a fee and they can change the terms at any time, which I don't like. Here's the Charles Schwab S&P 500 fund. I couldn't find any details on this, if there's any withdrawal restrictions. See, under short-term redemption fee, it says no. And then under frequent trader policy, it says, please see the fund prospectus, but I looked and I couldn't find anything. And then there's a thing here that says contingent redemption fee, and it says not available. I don't believe Schwab has one, but you'd have to call and double check. It appears that Schwab has a short-term redemption fee of $49.95, that if you actually hold the fund for 90 days or less, but you may want to call and check just to be sure. Okay, here's the one for Vanguard. Limits an investor's purchases or exchanges into the fund for 30 calendar days after the investor has redeemed or exchanged out of the fund account. ETF shares are not subject to the frequent trading limit. What are closed-end funds? I'm not going to spend too much time on this because closed-end funds aren't very popular or relevant today. Closed-end funds are the oldest investment form out of the 3 that we're looking at today. It started in 1853. They trade like a stock. It has higher fees than many mutual funds. Usually they're actively traded, and as a result, the fees are typically higher. They're not passively managed typically. Price often diverges greatly from net asset value. That's one of the largest complaints, is that usually they sell at a discount to the underlying assets. Not as tax efficient as ETF, not as popular or relevant today. Closed-end funds sort of reminds me of AM radio. It's still there, but it's waning in popularity. The first ETF, or exchange traded fund, started in 1989. It was called Index Participation Shares, and it was a S&P 500 proxy. ETFs first became popularized in 2010 when Jack Bogle of Vanguard started the S&P 500 fund. ETFs are the most tax efficient. Now, if you look here at this chart, you can see here that this black and white, this was years before ETF creation. These are taxable gains. This black and white is taxable. This is what people were paying before. After ETF creation, all this blue, they're non-taxable gains. These are things that would normally be taxed, but because of the way the ETF works, they're not taxable. So you can see how much money it's saved as a result. The net asset value. Number 5, the net asset value price is adjusted every 15 seconds typically with an ETF, whereas with the mutual fund, it's only once at the end of the day. Their ETFs are usually passively managed. Now there are some actively managed ETFs, and there's actually quite a few that are starting up. However, that's changing. And actually on YouTube, there's a YouTuber that's sort of famous. You probably heard of him, Meet Kevin, who's started his own ETF that's actively managed. And they basically share the same, as far as I know, they basically share the same type of tax loophole, the tax benefits that a passively managed one shares. ETFs. Number 7, ETFs are better for clients and easier for fund managers. Now, in order to get all the tax benefits with the mutual fund, they have to do a lot more tricks. There's a lot more work involved. And it's a lot more work involved with the redemption process. The mutual fund has to do a lot of the day-to-day work when somebody wants to take the money out. Whereas with the ETF, it's a lot more hands-off and it's a lot easier. Number 8, growing in popularity. ETFs are growing in popularity. Here you can see global ETFs saw record inflows in 2021. And here's a chart that shows that. I've seen other charts where you can actually see the mutual funds are kind of going down a little bit. And then that the chart, is with the ETFs, it's more of a going up more. Floodgates open on mutual funds converting into ETFs. Dimensional just converted $30 billion worth of mutual funds to ETFs. What it could mean for the industry. Vanguard also has a conversion process where you can convert your mutual fund to an ETF. Number 9, offers a wide variety of complex strategies beyond investing. You can see here there's a lot of this stuff is speculative and for traders, but it is nice that these things are available. So you have inverse ETFs. That's basically you want to do the opposite. So most people are investing that stocks are going to go up. This is basically investing that they're going to go down. ETFs for obscure countries, leveraged ETFs, ultra-specific sector ETFs. Number 10, with an ETF, you're buying and selling directly from investors, not the fund itself. ETF has authorized market participants, also known as institutional investors, that can buy the underlying shares in exchange for ETF shares, and then buy or sell to help correct any net asset value discounts or premiums. Both the underlying securities and ETF shares can be bought or sold. So that's a benefit of the ETF that the closed-end fund didn't have. That's why they were always mispriced. If the ETF is selling at a discount or a premium to the share values that it holds, they can come in, they can donate shares that match the ETF, and then they can take out shares of the stock, or they can take the ETF shares, and then they can buy or sell either one depending on which one they can make the most money on. They call that arbitrage investing. Number 12, ETF has limit orders and stop orders, unlike mutual funds. So this is the thing that's always bothered me with, I like to use limit orders when, if I have a large amount of money and I'm going to buy or sell, I'm just a little bit worried about, the price of it going up or down, or I want to get the best price. So maybe I'll place an order and I'll look for the trading range, kind of the low for the day or the low for the week, and I'll pick something near the low end of the range. And if I'm not really desperate to where I need the money right away, I could wait a couple weeks or a few days. I'll put in the order. You just sit back and you'll get an email or a text message when it goes through. But a market order is like going to a car dealer saying, I'll take that car. I don't care what the price is, just give it to me. A limit order is like going to the dealer and saying, you know what, I'll take that car for $9,950 and not a cent more. And then they can either reject it, or you can sit on it until they accept it or not. And with the mutual fund, you're basically just selling sort of at the end of day at the net asset value, and you don't really know what you're going to get. Number 13, ETFs may on rare occasions have higher than normal net asset value disparity from the underlying stocks during times of market volatility, flash crash, or other issues. Now, if you look at this chart here, this is VOO, Vanguard S&P 500 ETF. You'll see most of the time it's like 0.01, 0.02, but there are times where it's, it could be 0.06. Here's 1.11. We see most of the time it's pretty, it's not too much of a variance. It doesn't happen that often, so it's not a huge issue. I would rather have the features that an ETF has and the flexibility to be able to place a limit order and to do all these things than to have a mutual fund. Okay, so I've talked about the cons of mutual funds, but what about the pros? Automatic investing for mutual funds is offered by nearly every brokerage. So Vanguard has it, Fidelity has it, Schwab has it. I just looked, I think T. Rowe Price has it. Basically everyone has it. So you can have the money come out of your bank account. You can, on a regular basis, and invest in a mutual fund. Number 2, some say that mutual funds lead to longer term investing and less trading. They see stocks as risky, and they see ETFs as basically stocks, and that if you own ETFs or stocks, you're going to be buying and selling all day long, like a gambling addict. However, I found 2 brokerages that will actually do automatic investing for ETFs, and one of them will even do stocks. That's not much of an argument anymore. And even one of the people that made this argument was Jack Bogle a long time ago. So maybe it's just a case of the new things. People tend to exaggerate. When something new is out, they like to think the worst. So AI is going to take all of our jobs away right away. Casinos, a new casino moves to town. Everybody's going to be gambling addicts. Marijuana gets legalized, and of course everybody's going to be high all the time and driving drunk or whatever. So I think people just exaggerate when there's new things. In the 50s, if you watch some of the Twilight Zones, of course robots were going to take over the world, right? And look where we are today. They still haven't taken over. Why are ETFs so much more tax efficient? Okay, there's a loophole. Number 1, there's a loophole in the tax code that avoids taxable gains. Now, this was a law that was changed in 1969 of the tax law, and it was kind of an oversight. They didn't expect people to jump on it, but this sort of error or change was made, and then the investment community, the ETF, basically figured it out, and they're using it now for their own advantage. What the rule says is that a fund can avoid recognizing taxable gains on appreciated stock if the shares are used to pay off a withdrawing investor. The rule applies to both ETFs and mutual funds, but mutual funds rarely take advantage of it because their investors almost always want cash. See, that's the problem with mutual funds, is there's no third party. So when somebody says, I want my money, they're cutting them a check, and that's a problem because it's going to be a taxable gain. But if you hand shares to a broker and then the broker cuts the check, then you can get away with it, and there's no, the middleman changes everything. 3, use of heartbeat trades if a company in the index is going to change by asking an authorized participant, such as a bank or a financial institution, to donate identical shares, and bank then asks to withdraw money but gets old shares instead, wiping out taxable gains for the ETF. Okay, so this gets rather complicated. So if I had to redo this like 2 times. If I make a mistake, somebody can mention it in the comments. Basically, the way I'm not a tax accountant or anything, but I've got a degree in finance. So in accounting, they have a thing called first in, first out, which is called FIFO. And that's typically how you do your business. That's how you calculate your profit. So when you buy a share of stock, that would be your first one. And then you buy a second one, that's the next one. And your oldest one is going to have the largest amount of gains typically, because if you bought Coca-Cola back in 1950 and you sold it today, there's going to be more appreciation and tax that you would have to pay than if you just bought it today and sold it tomorrow. The way this thing works is you're trying to get those early shares, the early shares, and swap them out with new shares and give them to someone else. The third party comes in, the investor comes in with let's say 500 shares of stock that match the index. They deposit it to Vanguard. They let it sit for a day or two. And the reason they let it sit for a day or two is if they let it, obviously it would be more efficient if they just let it sit for like 100 milliseconds or a couple minutes and then sold it. But they're afraid of IRS scrutiny. So if the IRS asked them, why did you make a trade for 100 milliseconds? What was the logic behind that? They would have more difficulty explaining themselves in that situation over if they held it a couple days. So I think that's the reason why they say that the industry standard is 48 hours. So people say like a day or two, they'll do it. The bank then will ask Vanguard, say, hey, I would like to withdraw my money. So then Vanguard gives them their shares back, but they don't give them their shares back. They give them the old shares back. And then it wipes out the huge capital gains from when Vanguard, let's say, had the shares for a long time. Number 4, why use heartbeat trades? When a buyer is not available to buy or exchange a large amount of shares, or a transaction has to be done by a certain time, the ETF manager may ask for help. So like in the article that I read from Bloomberg, Monsanto was bought out by Bayer. Vanguard had owned this Monsanto for a long time and they'd have huge gains. You have to have a buyer for the shares, and so they don't want to do it at the beginning, right away. They want to wait to the very last minute in the tax year. They may wait, the last week to do it. And then the third party comes in, just like I mentioned the previous thing, and they do the share swap, and then they wipe out the gain. And why is it called heartbeat? Because it's a large blip in the trading volume. As you can see here on this chart, the woman that discovered it, she said it looked like an EKG on a heart monitor in the hospital, because it's like a blip, blip, blip. You'll see this trading volume spike up really high for a short period of time and then go down. That's why she called it heartbeat. Why are ETFs more tax efficient than stocks? Number 1, when a company is bought out for cash, the ticker disappears from the portfolio and cash appears in exchange, leading to a forced capital gain. ETFs avoid this because they are always exchanging for stock, such as adding a new stock to the index when the old one is removed. So it's sort of like the 1031 exchange that people in real estate use, where they'll sell a apartment complex, and then within like 45 days they'll buy another apartment complex that's the same value or higher, and then they can just keep upgrading without paying any taxes. It's basically like starting out with a Toyota Corolla, going up to a BMW, to a Lexus, to a Rolls Royce, and you can just keep, to a Ferrari, and to just keep going from there. But the ETF avoids that because they're always trading stocks. They'll trade, rather than get cash for it, they'll exchange for stock, and then there's no gain. Okay, so how do ETFs work? This is a rather complex topic, so I'm going to use some analogies. Feel free to comment in the description if you notice any mistakes that I make, but I think I'm about 85% right. Okay, number 1, ETF is sort of like the Costco food court. The hot dogs, the churros, the pizzas, and the food items are like stocks that are pooled together. After paying for the order and getting the receipt, After paying for the order and getting the receipt is given to the cashier, who acts sort of like a broker, but instead of giving you food, she just gives you back the receipt. The receipt is like shares that you own in the ETF that can be bought or sold by other investors. If pricing mismatches occur, authorized financial participants can come in and buy and sell the ETFs, buy and sell the underlying stocks in exchange for ETF shares or vice versa. Imagine that on a hot, muggy day, the demand for Costco's ice cream sundaes goes way up. For the purpose of this story, let's imagine the supply is running low and Costco increases the price for sundaes to $5. A third party on the outside has a deal with an ice cream manufacturer who sells sundaes for, let's say, much less, let's say $1. The price of the ticket receipt is greater than the real market value for ice cream sundaes on the outside. So the ETF is overpriced or selling at a premium relative to the underlying assets. So what can they do about it? Okay, so what can they do? They need to get the price of the Costco ice cream down so that it matches the price of the market on the outside. The authorized participant can buy up a bunch of sundaes, take them to Costco and exchange them for order receipts, or in this case ETF shares. Then the AP, authorized party, can sell the tickets to others in the store for a profit, for $5, making a profit. He buys the sundaes for $1, sells them for maybe a little bit more, and then sells the authorized participant can buy up a bunch of sundaes, take them to Costco and exchange them for order receipts or ETF shares. Then the authorized participant can sell the tickets to others in the store for $5, making a profit. Others can jump in and do the same thing, and before you know it, Costco's overflowing with sundaes, and they drop the price of ice cream sundaes. This is how market participants help keep the price of the ETF to be very close to the underlying stocks. Okay, so that was a case where the ETF was overpriced or selling at a premium relative to the stocks. Example 2 is when the ETF value falls below the underlying stock and it's selling at a discounted price. Imagine that the ETF fund is owned primarily by a large group of doctors. They are all on vacation in some remote island that has no internet access. The underlying stocks have all recently reported great information, good quarters, and one of the companies came out with a revolutionary robot hamburger flipper, and the stock prices skyrocket. The authorized market participants who typically buy and sell the ETF and underlying stocks, there's a major flood in New York City, and they are all disrupted as well as the investors. So when the underlying stocks go up in value, nobody's available to purchase more ETFs or do arbitrage trading to help correct the mismatch, and the ETF fails to go up in value in tandem with the underlying assets for a day or so until everybody is back. Why is it that Vanguard mutual funds offer higher tax efficiency than other company mutual funds? Number 1, patented pool of assets. Vanguard ETFs and mutual funds own the same pool of stocks. From what I've read, they pool the money into the same group, or they'll swap stocks between the mutual funds and the ETF, and that's by doing that they're able to reduce the tax liability. Number 2, use of corresponding ETFs to buy and sell heartbeat trades. Vanguard asks a authorized party such as a financial institution to donate shares matching the portfolio, then take out the old shares instead, leaving new shares behind with less taxable gain, or very little since it's usually no older than 48 hours old. The bank will then ask to withdraw the money after a day or two, and the ETF complies and gives the old shares to the bank instead, wiping out huge capital gain liability. The ETF keeps the new shares and disposes of the old ones and sells them shortly after. That's if something in the index is being removed. Number 3, patent. Their patent expires in 2023. Rivals could copy the structure when the patent expires, but a lot of people are saying that they're not going to copy it because it's like copying Blockbuster Video when Netflix streaming arrives, because the ETF is just much simpler to run. And so why would you go through the hassle of doing all this legwork if there's a easier way? Okay, here's the Robinhood app. You basically go to Discover More and you look for reoccurring, and then you click Create Reoccurring Investment, and select your account. Then you just put in your ticker symbol, okay, VOO. Then you add to basket like you're adding something on Amazon. Hit continue, and then you can choose your frequency, how often you want to invest, have the investment. So you could do every week, every 2 weeks, every month. You can put in the amount. This will be $25 every week. Very simple. Robinhood is the winner so far for reoccurring ETF investments so far, because you can do it on mobile and you can do stocks. Okay, here's how you do reoccurring investments from the Robinhood website. Now you go to their main website and you go to account, then you go to recurring, and then under recurring investments, you click Create Reoccurring Investment. Then you pick your ETF. And I believe Robinhood has more reoccurring investments than eTrade has. You can actually do stocks with Robinhood. So I would say maybe for somebody that wants more options, Robinhood is probably number one right now. I think next to M1, I think you can also do stuff, but I'm not sure completely about that. So I would say Warren Buffett and Charlie Munger sat down with the Charlie Rose interview, and Charlie Munger was really critical of Robinhood. He was calling it a gambling parlor and saying all kinds of nasty things about them. But, what if he knew that they had reoccurring investments? Would he still do the same thing? Because this does not seem like a gambling parlor to me. If you're investing, let's say $25 every week or $100,
some of the areas that come up.
Robinhood is beneath contempt.
Why?
Well, it's a gambling parlor masquerading as a respectable business.
And the pushback on that is always, this is a way of getting average people into the markets.
Well,
people
of
who didn't have
course you don't
access.
want to say it's a gambling parlor, but it is a gambling parlor.
It's not encouraging people to buy a very, very, very low-cost index fund and hold it for 50 years. I will guarantee you that you will not walk in there, get that advice. No. Instead, you'll get advice on how you can trade options, and they'll tell you that.
And it's telling people they aren't paying commissions when the commissions are simply disguised in the trading. It's basically a sleazy, disreputable operation. And the interesting thing about it is that some good people you would be glad to have marry into your family have backed it.
Dollar cost averaging is not gambling. So I think maybe he was looking at the old Robinhood. So I would say, Robinhood may be a good long-term investing platform now. And when I tried them years ago, I don't even think they had the website. Now they've got a website. I've had this account for a long time, but I've never used it because I'm kind of old-fashioned. I've got eTrade and a bunch of these old-fashioned accounts. And they've got a lot of features here. You can get a debit card, lots of different things. Here's the promotion. I can invite some people. We slice whole shares into smaller pieces of stock. Get 5 to 200 in stock. Everyone gets stock. 1 in 100 customers can get at least $10. 1 in 1,000 can get 200. Anyways, this is just showing you that Robinhood is not just some gambling parlor for day trading or whatever. You can actually do dollar cost averaging with ETFs, which I've been wanting to do for a long time. So I would say check them out. And I'm going to put a link in the comments and the description. You can try them out. Here's another thing I noticed that's kind of interesting that they have. Robinhood has a 1% match for an IRA. They do a match up to $60. This is their fee schedule. Pretty basic. Now, a lot of the fees that they have are back-end fees, like I was saying, the Citadel. So they're going to be in the form of a bid-ask markup or spread. So maybe you're not going to get the best trade execution because it's going to a third party and they're probably marking up your shares. So you're paying for it in the back end, but it really simplifies things not having any trading commissions. So I still kind of, I understand some people don't like it, but I don't like commissions either. So this simplifies the math when you're trying to calculate your profits and everything. So I'm not as critical as people like Charlie Munger, but I do see their point. If you do electronic statements, it's free. Paper statements, $2. Everything else looks pretty normal here. It's not like some of these brick and mortar bank accounts where they've got all these crazy fees. You can see account. Now, I've actually had this account for about a year. They closed it because I never funded it. And I just opened it back up, and I'm going to fund it now. And not a big problem at all. And the customer service was easy to get a hold of. They were friendly. So far, I'm actually pretty happy with them. But nothing looks that outrageous here. Here is the Robinhood debit card. Earn a 10 to 100% bonus each week when you round up your Robinhood cash card transactions and invest your change. Bonuses are capped at $10 each week. Invest a part of every paycheck. You can invest a percentage or dollar amount of every paycheck, plus get paid 2 days early. Okay, here you can see the fees on the Robinhood spending account. There's a zero monthly fee, $0 per purchase, $0 in network. This is nice, $0 out of network. So I'm guessing you can use any ATM. Maybe that's worth it if they give you a lower fee if you're somebody that uses a lot of ATMs. Inactivity, there's no fee. Transfers to external debit card, 1.5%. We do not currently offer overdraft or credit features. Your funds are eligible for FDIC coverage. Monthly fee, direct deposit, early pay, $0. Receiving money, $0. Adding money from your bank account, $0. We charge no fee out of network. That's pretty rare. I haven't seen anyone offer that really, other than I think Charles Schwab. Using your card. Okay, so this may actually give the Charles Schwab checking account a run for its money, or the Charles Schwab debit card. International, 0%. International ATM withdrawal, 0. Well, it says you may be charged a fee by the ATM operator. Okay, so it doesn't say that they actually cover that fee, so Schwab is going to be the winner there because they actually cover that fee. No inactivity fee, that's good. No interest. Wow, there's no interest, so that's it for me. I wouldn't use it. I think there's better options. Unless you're somebody that really needs to use the ATM like all the time, then maybe this is the thing for you. But no interest, that's a deal breaker for me. Okay, so Robinhood is also doing something that M1 Finance is doing, or maybe M1 Finance is doing what Robinhood has done for a while. They're charging $5 a month, and they call this Robinhood Gold. It gives you 4% interest on your money. No cap, 1.5% without gold. You can get up to $50,000 of your deposits instantly. And then they give you the advanced quotes. Now, I think eTrade gives you level 2 for free. I think I've had those for years. I'm going to put a link to Robinhood in the description in case you want to sign up and you want to play around with recurring investments, or you want to use them for their checking account or their IRA match or whatever else. And you'll get slices of stocks, I think. You'll be able to get some or win some. And I'll also do eTrade, but eTrade doesn't really have much of a bonus unless you put in like $20,000 or $30,000. I'll put a link below. Okay, so I decided to look at the Robinhood SEC 606 form. Now, this is a form that the SEC requires that all brokerages create since like 2020. And it basically means that the brokerage has to disclose pay for order flow. So when I looked at Robinhood like a few years ago, they were one of the worst. You could see all this stuff here that says net payment paid. You had like huge numbers. Now when you look at it, it's all 000. So like the far one on the right is usually the largest number. And you look at it now and it's like they've totally changed that everything's good, right? Net payment paid, 000. Okay, this is what I actually thought. Okay, I thought that they had changed, right? I have something to tell you. They didn't change. Some entity is getting paid for order flow and it's disclosed somewhere else. So now when you look under venues, Now you see the venue. It says, what does it say here? It says Robinhood Securities, LLC. Now Robinhood has like 3 different entities. There's Robinhood Securities. Here you can see right here. Robinhood Financial, Robinhood Securities. It routes the customer orders. If you read, this is the footnote here. It routes the customer orders to an affiliated clearing firm, Robinhood Securities, RHF. We go and we look at all this stuff here. It's all 0, 0, 0, 0. Even for options, like everything is 0. There's like they look like they're like an A student, like they're not getting paid for anything. And this is the most up-to-date reports, August 2022. So you look at all this here. All you see are the footnotes. Non-S&P stocks, like all the stuff is 0. Okay, now let's look at something else. Okay, now we have the latest quarterly report from Robinhood. It's a publicly traded company, so this is available. You can see concentration of revenue and credit risk. We derive transaction-based revenues from individual market makers in excess of 10% of total revenues as follows. Citadel Securities. Why wasn't it in the form? Oh, okay. 17%. Look at that. That's a big one. It's actually down from 21% in 2021. Robinhood got sued for deceptive marketing because they said their order execution was like better than average a few years ago. And I guess they didn't disclose of all the stuff like this, all the Citadel are. Okay, so Robinhood was recently sued a couple years ago because they were fined $1.25 million by regulators for how it executed trades and highlights the issue that can arise for payment for order flow. They had a $1.25 million. They routed non-directed stock orders to 4 broker-dealers, then paid it for the trades. But it's not illegal, but Robinhood's methods fell outside the agency's guidelines. Okay, here you can see the footnote that I've blown up so you can read it. It says RHF does not receive payments or pay transaction fees for any portion of such order executed in principal capacity. Revenue and costs that RHF receives and pays, including revenue from third-party market centers, are shared with RHF pursuant to a revenue and cost allocation agreement. I mean, that sounds like they're getting paid, doesn't it? Additional information regarding payments made or received by RHS can be found on its quarterly Rule 606A report. I thought I just looked at the 606, but maybe there's another one. Let's go look. Now let's scroll down and see what else. This was actually, and these are S&P 500 stocks. These are the ones that are supposed to be the cheapest usually. Non-S&P 500. That's surprising. It's actually less. 14 cents. 11 cents, 19 cents per 100 shares. This one, they received $1.4 million. And that's like in a few months. Citadel, that's not like for a whole year. That's like a few months, I think, or 1 month. Okay, now we're at, wow, this is 51 cents, 48 cents. Citadel, that seems to be the big one. Is this still no, these are options. Wow, this one is 100, this VOO is really high. 131 cents. I guess that's $1.31. I mean, that's still cheaper than what maybe 10 years ago. The cheapest was like Options House. It was like $3 per 100 shares, and it's still cheaper than that, but it's done on the back end. It's kind of sneaky. Market orders versus limit orders. Which one pays more? S&P 500 stocks. Market orders make up non-marketable limit orders. Marketable limit orders, I think that means ones that executed, 19%. So actually market orders made up more orders than limit orders, it looks like. Now limit, here you actually can see market orders made 90,000 from Citadel. Marketable limit orders made 50,000. So market orders made almost twice as much as limit orders. The price for a marketable limit order was 22 cents. Which costs more, a market order or a limit order? A market order, a marketable limit order, I think that's one that executed, made 22 cents. A market order made 24 cents. And it looks across the board. Here's another one. The market order was 48 cents versus 45 cents for the limit order. So if you want to keep Robinhood from making money, place limit orders, because they're going to get like 2 cents less. The thing that's remarkable about Robinhood is how much money they're making on the S&P 500 stocks. Those are typically going to be the cheapest because they have the most volume. So you would think that this would be the lowest, that these would be the lowest fee. But, you know, this one is 123 cents, 62 cents, $1.23, 62 cents. That's outrageous. After doing all this research, would I still use Robinhood? Yes. Why would I still use Robinhood? Okay, this is the main reason. SIPC. Now, SIPC protects the securities in the account, such as stocks and bonds, up to $500,000. When Bernie Madoff stole the money from his clients in securities, they protected each person up to $500,000 and paid those people back. The same with Lehman Brothers. They have billions of dollars to do this sort of stuff. Also, there's not many choices. If you want to do ETF, automatic investing, and if you want to do stock automatic investing, I don't think you have any options other than perhaps M1. So I would definitely still use Robinhood. This protection is more than enough to ease any concerns that I would have. So which is best, a low-cost index fund mutual fund or a low-cost index fund ETF? Well, in the long term, they're both going to do great. I mean, they're both great options for investing. In a marathon race, they're basically all side by side, and there's not much difference. They're all sort of neck and neck, so I think they're all fine. We're basically just sort of splitting hairs here. But for an ideal use case scenario, I would say that a mutual fund would be best in a tax-deferred account, such as an IRA or 401k, where it can shield you from some of those leaky capital gains that happen with some of the non-Vanguard mutual funds. And also the restrictions as far as the withdrawal restrictions, they're not going to matter so much in a tax-deferred account because there's already restrictions and penalties in place typically. For the ETF, I would say a taxable account would be the ideal use case scenario. Somebody that wants to do limit orders to be able to get the price when they buy and they sell. If you like this video, please press that like button so you can tell YouTube to recommend this video to others. And also feel free to subscribe. Thanks and have a happy new year.